Ladies and gentlemen, Asian guy here. I need you to stop what you're doing right now. I need you to put down your phone and listen to me very carefully because what I'm about to tell you will change how you see every market move for the rest of your life. Silver just crashed 37% in 3 trading sessions, from $79 to $49.80, the largest single drawdown in precious metals since the Hunt brothers collapse in 1980. The financial media is calling it profit taking. They're calling it a technical correction. They're telling you this is normal market behavior. They are lying to you. This was not an accident. This was not retail investors panicking. This was not algorithms gone wrong. And what we just witnessed was the most sophisticated, most calculated, most brutal market manipulation in the history of commodity trading. And the entity behind it just revealed their hand. You see, for weeks we've been tracking the Shanghai premium. We've been watching Chinese factories pay $80 while New York traded at $71. We documented the arbitrage breakdown. We showed you the 750 million ounce JP Morgan hoard. We proved the system was breaking. But we made one critical error. We assumed the banks were losing control. We thought they were trapped. We believed their own narrative that they were short and desperate. What we didn't understand is that they weren't losing control. They were taking control. They weren't trapped in the rally. They engineered the crash. The crash started exactly at 3:17 a.m. Eastern on a Tuesday. The London market was closed. Shanghai was in pre-market. New York algorithms were running on skeleton crews. This is not when normal selling happens. This is when professionals execute planned operations. But look deeper at the mechanics. The selling didn't start with one massive block. It started with precision strikes every 30 seconds. Block 1, 15,000 contracts at $78.90. Block 2, 18,000 contracts at $76.50. Block 3, 22,000 contracts at $73.20. Each block perfectly calculated to break the next support level. This requires military-level coordination. Someone was watching order flow in real time. Someone knew exactly where every stop loss was positioned. Someone had mapped the entire liquidity structure of the silver market and designed a demolition sequence. In 17 minutes, over 150,000 futures contracts were dumped into the market. That's 750 million ounces of paper silver, exactly the same amount as JP Morgan's physical hoard. This is not a coincidence. The execution signature tells us everything. Normal institutional selling spreads out over hours or days to minimize market impact. This selling was designed to maximize impact. They wanted maximum pain, maximum fear, maximum psychological damage to anyone holding silver. Think about the mathematics. To move 150,000 contracts in 17 minutes requires coordination across multiple prime brokers. It requires pre-positioned inventory. It requires clearinghouse approval for massive position sizes. You cannot execute this trade from your home office. You cannot execute this trade without institutional backing. But here's what broke my brain when I saw the execution data. The selling wasn't random. It wasn't emotional panic. Every single tranche was precisely calibrated to hit specific technical levels. They broke $75 support. They triggered $70 stops. They smashed through $65. They didn't stop until they hit $49.80. Why $49.80? Because that's exactly 37% down from $79. In the professional manipulation playbook, psychological round numbers matter. 30% is a correction, 40% is a crash, 37% is the perfect middle ground, severe enough to create maximum fear. Not severe enough to trigger regulatory intervention, but the real genius was the speed. 3 days, not 3 weeks, not 3 months. They wanted to psychologically break every retail investor who had bought into the silver story. They wanted pension funds to panic. They wanted mining companies to question their business models. The volume signature tells the whole story. In a natural sell-off, volume starts small and builds as more participants panic. In this crash, the heaviest volume happened in the first hour, before anyone even knew what was happening. This is the signature of a premeditated strike. But the smoking gun isn't the execution, it's the timing. 3 days before the crash, we saw something unprecedented in the repo market, a $43 billion reverse repo operation, the largest single-day liquidity injection since March 2020. Why would the Fed flood the system with cash right before silver collapsed? Because they knew it was coming. But it gets darker. That $43 billion wasn't random liquidity. It was specifically routed through the primary dealers who trade commodities: Goldman Sachs, JP Morgan, Citibank. The exact entities that would need massive cash positions to execute a coordinated silver dump. The Federal Reserve didn't just know about this manipulation. They financed it, they provided the ammunition, they created a war chest specifically designed to break the silver market. And they did it 3 days in advance because they knew exactly when the attack would happen. Look at the Federal Reserve Bank of New York's daily operations report for the week before the crash. Every single day, they injected fresh liquidity specifically into commodity trading desks. They weren't responding to market stress. They were preparing for market stress that hadn't happened yet. The liquidity injections followed a specific pattern. Monday, $8 billion to primary dealers. Tuesday, $12 billion to swap lines. Wednesday, $23 billion through reverse repo operations, each injection larger than the last, each injection timed to build maximum ammunition for the coming assault. You have to understand what was happening before the crash. Silver at 79 down wasn't just an investment play. It was becoming a parallel currency. Chinese manufacturers were using silver bars as working capital. Russian oligarchs were parking wealth in London vaults. Indian families were converting rupees to metal. The dollar was being bypassed, not by Bitcoin, not by gold, by industrial silver, the one metal that every modern technology requires, the one metal that China needs for solar panels and EVs, the one metal that Apple needs for iPhones and Tesla needs for batteries. Silver at $79 was telling the world that the dollar was overvalued, that American debt was unsustainable, that the printing press had lost its power to command respect. This could not be allowed to stand. So the Fed made a deal with the devil. They gave JP Morgan and the other bullion banks unlimited swap lines, unlimited margin, unlimited ammunition, with one simple instruction. Break the silver market. Make it look like retail speculation. Make it look like a bubble bursting. Restore faith in paper currency by destroying faith in hard assets. The execution was flawless. At 3:17 a.m., when the world was sleeping, they opened the floodgates. They dumped paper contracts like confetti. They triggered every stop loss. They broke every support level. They turned a 4-year bull market into a 3-day bloodbath. But here's what they didn't expect. Physical demand didn't collapse. Even at $49, Chinese factories kept buying. Indian dealers couldn't keep inventory. Coin shops in America saw lines around the block. The paper price crashed, but the physical market stayed tight. The disconnect is now mathematical. Silver Eagles are trading at $15 over spot. Canadian Maples at $12 over. Even generic rounds are commanding $8 premiums. When premiums explode while spot crashes, it means the paper market has lost all credibility. I called 3 major dealers this morning. All 3 told me the same thing. Delivery delays have stretched from 2 weeks to 8 weeks. Not because of logistics problems, because they cannot source inventory at anything close to the paper price. They're telling customers the spot price is irrelevant. The real price is what they have to pay to replace inventory. This created the most dangerous situation possible for the manipulators, a complete disconnect between paper and physical. Right now, you can sell silver futures at $49. But try to buy physical silver. Try to get delivery. The premiums are exploding. Dealers are quoting 6-week delays. The Shanghai premium has blown out to $15. Shanghai is now trading at $64, while New York quotes $49. That's a $15 premium. But it's not a premium anymore. It's the real price. Shanghai reflects what silver actually costs when you need actual silver for actual factories. They crashed the paper market, but they couldn't crash reality. And reality is about to strike back. Because now we have verification of something much darker. This crash wasn't just about silver, it was a stress test. It was practice. They wanted to see if they could crash a strategic commodity market without triggering systemic breakdown. They wanted to see if they could manipulate prices without losing control of physical supply chains. The test results are in. They can crash any market, anytime, without consequences. The regulators stayed silent. The media blamed retail speculation. The system absorbed a 37% commodity crash in 3 days without blinking. They succeeded, which means they're going to do it again. Gold is next. Oil might follow. Copper, lithium. Any asset that threatens dollar hegemony is now in the crosshairs. Any market that shows independence from Federal Reserve policy is marked for destruction. The crash proved something terrifying. The free market is dead. What we have now is a managed casino where the house controls every outcome, where prices are set not by supply and demand but by political necessity, where paper derivatives can overwhelm physical reality through sheer force of leverage. But managed systems have a fatal flaw. They work until they don't. They can suppress reality for years. Until one day, reality refuses to be suppressed. Look at what's happening right now in Shanghai. Despite the paper crash, Chinese silver imports are up 340% month over month. Despite the manipulation, Indian silver demand is hitting all-time records. Despite the coordinated attack, physical silver remains impossible to source at spot price. London dealers are reporting wait times of 12 weeks for large orders. Swiss refineries have stopped taking new orders entirely. Mexican mines are selling directly to Chinese buyers, bypassing Western markets completely. The physical supply chain has fractured along geopolitical lines. The paper price says $49. The real price is whatever you can actually buy it for, and that number is not $49. This disconnect cannot hold. Eventually, either the paper price must rise to meet physical reality, or the physical market must decouple entirely from paper pricing. Either outcome destroys the manipulation mechanism, They won this battle, they crashed the price, they shook out the weak hands, they restored temporary confidence in their printing press, but they lost the war. Because now everyone knows the game is rigged. Now everyone knows that market prices are political decisions. When trust dies, the system dies. When people stop believing in fair markets, they stop participating in fair markets. They hoard, they barter, they find alternatives. The 37% crash wasn't market forces. It was desperation. It was the dying gasp of a monetary system that knows its time is running out. It was proof that they will do anything, manipulate any market, break any rule to maintain their grip on power. But power based on deception is brittle. It works until people stop believing. And after this week, who can believe in fair markets anymore? Who can trust that the price on their screen reflects reality? The crash is over. The manipulation worked. The price is back to where they wanted it. But the cost was enormous. They revealed their hand. They showed their capability. They proved the rumors about coordinated intervention. Most importantly, they proved they're afraid. Truly, deeply afraid. Because if they weren't afraid, they wouldn't need to manipulate. If the dollar was strong, silver at $79 wouldn't threaten them. If the system was stable, they wouldn't need to crash commodity markets to maintain confidence. The 37% crash was their confession, their admission that the game is rigged, their acknowledgement that reality is their enemy. But reality has a way of winning in the end. Physics doesn't care about paper contracts. Chemistry doesn't respect central bank policy. Industry needs silver regardless of what JP Morgan wants the price to be. The crash is over. The manipulation worked. For now. But every crash creates the conditions for the next rally. Every manipulation teaches the market how to defend against the next attack. Every paper dump transfers metal from weak hands to strong hands. They crashed it from $79 to $49. But $49 is still double where it was 2 years ago. They stopped the rally, but they didn't kill the trend. They won the day, but they're losing the decade. The 37% crash wasn't an accident. It was a planned execution, a coordinated strike. A desperate attempt to maintain control of a system that's spinning out of control. They succeeded in breaking the price, but they failed in breaking the demand. They succeeded in restoring temporary confidence, but they failed in restoring long-term trust. The paper markets are rigged. The physical markets are real. The disconnect is widening. The end game is approaching. The crash proved they have the power to manipulate any market at any time, but it also proved they need to use that power. And systems that depend on constant intervention are systems that are already failing. Watch Shanghai. Watch the premiums. Watch the delivery reports. The paper price is a lie designed to maintain order. The physical market is truth designed to reflect reality. 37% in 3 days. This was no accident. This was the system showing its teeth. But when predators show their teeth, it usually means they're cornered. The hunt is just beginning.